Welcome to the December 17th, 2018 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, president, McGowanGroup, for a fast-paced tour of the global financial markets each and every week, and when there's breaking financial news. If you subscribe on the YouTube channel and we have a big market event, boom, you're going to get the inside track with the graphics. So let's begin our tour of this week's global financial markets, starting with the one-year chart for the S&P 500 index, the benchmark index for blue chip U.S. stocks. The Dow, very, very similar. You can see the range-bound effect in the rebalancing correction we had back in January. What happened on the S&P was a decline that took it to a loss for the year, a recovery here, and along about August, September, the market topped here, and we see the dramatic sell-offs, of course, to near the 2600 level on the S&P 500, not dissimilar to the lows this last year. This validates the premise that we've had since that correction, the winter storm we called it, that we are range-bound, digesting the previous gains that happened after 2016. So this week, you can see traders were also looking at this cross right here. They sold big sell-offs here and here. What we're looking at is a 50-day moving average versus a 200-day when they cross. There's a superstition by technicians that means the wheels have come off the go-kart. The economic data are the exact opposite, but it also raises the questions: if we can't rely on the market to produce consistent gains because it's range-bound, what are we going to do for gains? What are we going to do for total return? Well, as usual, we're going to come back to cash flow. How can we get paid enough money that we're succeeding based on our net cash flow alone, and make large gains potentially over time? Those are two subjects that we'll cover. Here's the first. Jerome Powell, Fed chair. Fed's been on a relentless path even since before he took office to raise interest rates back to what they consider neutral. He said we're near neutral. Well, let's see what's happened to the 10-year treasuries all across the world. China only pays 3.3 interest. The United States 2.9, Canada pays 2.11, Brazil only 5%, Argentina 10%, but United Kingdom pays 1.2 on a 10-year. That's less than half of what we pay. France just 0.7%. Do I want to loan money to France with all the riots this week, or and over the past few weeks, or are we looking at Germany, where we only get 0.25%? U.S. yields on a global basis relatively high. Now, we take the rest of the premise here. I can loan money to Greece. Oh my God, Greece, I get 4.2%. What the heck is that? I don't think I want to loan money to Greece for 10 years for 4.2. It just sounds like a bad idea. I could put my money in Switzerland, and they're going to charge me 0.5% every year. They're going to take my money just to hold it because Switzerland holds a lot of money. From ne'er-do-wells too, we'll add. And here, 0.4%, we look at that from the Netherlands. They got good oil revenue. I could understand that. 1.6. But notice, how many countries are below the 2.9 on the 10-year treasury? We have relatively high yields. This yield actually spiked to about 3.2. It pushed the mortgage rates up, and it took away all the growth in the housing market based on recent numbers. So where do we go? How about we buy stuff that's well diversified, paying over 6%, because Jerome Powell, according to this measure, and slowing global growth, he may be ahead of the curve, and he said he was nearly neutral, which means this week is a big week. Wednesday, the 19th, the Fed announcement that they'll probably go to 2.25% base rate for interbank lending. The T-bill's already at 2 1/3, telling you that's pretty much a done deal. Jerome already said he was near neutral. New cycle for fixed income, new cycle for cash flow assets, and that's your message for 2019. What two asset classes would we go to? Well, I don't even like 2.9%, much less paying money for somebody to hold mine. What does that mean? Let's go find stuff that pays over 6. A little bit more on the United States before we go there. Here's the T-bill. Relentless increase concurrent with the overnight bank lending rate. That's the 90-day T-bill on a 3-year basis. Here's a 3-year chart for the 30-year Treasury. It didn't rise during this period. Essentially flat with a 3.4% peak right here. That means that stuff paying over 6% has been under a lot of pressure. There's some appreciation potential. Where would we go? Well, there are a lot of bonds around the world that pay 6, 7, 8, and some bond funds even 10% that are trading at substantial discounts. That's a broad category we'll call global high yield. Get paid lots of interest with maybe a 7 or 8% target. There is price risk, so we need a discount to par. This weekend's program is going to cover more specifics about the global high yield bond category, where we potentially clip a coupon of 7 to 8%, and we could get some appreciation because they're trading below par value. That's at NetWorthRadio.com. You can hear the longer play program with more details. How about going to a category that's already had a bear cycle, that yields over the 6% we're looking for from a portfolio in real spendable or reinvestable cash? Well, look at this. We're looking at a 10-year chart for one of the pipeline leaders, two of the pipeline leaders, 10 years for Energy Transfer, Kinder Morgan. These are pipes. They're like a toll booth. Every barrel of oil, million BTUs of gas that goes through here, and the pipes are full coming out of the Permian. Well, what's happened to the cash flow? Well, revenue's this green line. Wow, that looks pretty good. What about the share price? Ooh, capitulation sell-off, tax loss selling, and they've lagged the revenue growth and the free cash flow. Boom, look at that. That's a lot of free cash flow, huge increases there. We've got Kinder Morgan holding steady, but in percentage terms, they are way behind the curve in share price. That could be energy infrastructure, one of the big potential bargains for next year, and an allocation that we've been researching for years. I started back in '93 on the pipes with a guy from ExxonMobil. He knew where all the pipes were buried and would buy the good ones. We've been doing that for 25 years. This is the team you want to trust with deep research and the right asset classes at the right time. Let's look at a couple of other smaller pipelines. Oh my gosh, same thing. Revenue way up. Share price flat to down. Wow, could that be a bargain? Energy's already had its bear cycle, I believe. And free cash flow, that's the purple line. We've also got free cash flow right here, big spike for MPLX, and we've got DCP up here as well. The entire pipeline industry appears to have reached a crossover point, and that could be a great bargain with yields above 8% going forward, and the index is arguably half price back from when the companies were making less money, and that was back over here. Wow, that's a potential bargain and an inflation-friendly asset class with the fundamentals of the shale revolution filling up those pipes along with liquid natural gas exportation. For more details, go to networthradio.com. Fill out your preliminary client questionnaire, come down, meet the team that cares, get your Texas Financial History private collection tour, and we will put a plan together for you in a 1-hour brainstorming session for the categories that could benefit you the most in 2019. I'm Spencer McGowan, your financial weatherman. Be back next week with the best in graphic financial news. My firm, McGowanGroup Asset Management, sponsors NetWorthRadio.com and, of course, our YouTube channel under McGowan Group. Some educational disclosures and discussions that I wanted to add to the broadcast. The first is, I'm very proud of our team, including Stephen Norris, who will be added as soon as we redo the picture. He's our newest team member. Come down, meet the team that cares, get a written plan, because the securities we discuss, the financial news we discuss, that's not a recommendation until you actually come down and get a customized plan at the Crescent. You'll get a tour, and we look forward to seeing you. We're going to cover value at risk of loss in portfolios, and you can see it right here. Learn about our performance. What happened in 2008? How long did it take to recover? All of those items are posted right here at networthradio.com or the McGowanGroup.com. The other part of the program, when we look at price fluctuations and bear markets and risk control, that's a huge part of networthradio.com. We look forward to helping you advance your plan and your cash flow. Come down and meet the team that cares.